Hey everyone, welcome to this new channel. This channel is to help people to generate money. As we head into April, let's dive into 3 stocks that seem like particularly strong additions to your portfolio. But before we jump in, I'd love to hear from you. Leave a comment below and tell me which stocks you're currently keeping an eye on. I'm always curious to see what interests you all. One company that I find particularly interesting is Zetus. In my opinion, it's a bit under the radar, and I think it deserves more attention. Now, if you haven't heard of Zetus before, let me fill you in. They develop medications, vaccines, and other animal health products. They're the top dog in treating cattle, fish, pigs, and even companion animals like cats and dogs. This segment is experiencing a surge in demand, driven by what they refer to as the growing human-animal bond. Pet owners, especially Gen Z and millennials, prioritize the health and wellness of their furry companions, viewing them as practically family. Even during economic downturns, pet owners are likely to spend money to keep their pets healthy, making Zetus a company with built-in resilience. Furthermore, Zetus plays a vital role in meeting the world's growing demand for protein by creating products that support livestock health. This contributes to a significant chunk of their revenue, around 35%. With the global population projected to explode by nearly 2 billion people by 2050, the demand for animal protein is sure to climb, and so should the demand for Zetus's products. Overall, I find a lot to like about this company. Looking at the share price, though, 2024 hasn't been kind to Zetus. Just last month, they experienced a crazy drop of about 16%. In fact, they've been on a pretty steady downward trend throughout March, resulting in a year-to-date loss of over 15%. However, zooming out to a one-year view, their performance is actually quite flat, with only a measly 0.35% gain. That said, with this 2024 share price decline, Zetus's current dividend yield is sitting significantly higher than its 5-year average. While the yield itself isn't particularly high, just barely past 1%, it's still well above the company's historical average. The rest of the dividend metrics are also promising. A low payout ratio, coming in below 30%, which we like to see, and a stellar 5-year growth rate exceeding 23%. I recently added Zetus to my own watch list for further exploration. I plan to dive looking like a pretty interesting contender as we approach April. They recently saw a decent drop after reporting their quarterly earnings. While they did manage to beat expectations on both the top and bottom line, the results weren't all sunshine and rainbows. The results showed a 5% quarter-over-quarter decline in footwear sales and a near 13% drop in apparel sales. This less-than-stellar performance led to a 12% decline in their stock price in the last 30 days. This drop translates to a year-to-date loss of over 14%. Looking at the broader picture, Nike is down a whopping 21% over the past year. Significant drops across the board, just like we saw with Zetus. Similar to Zetus, Nike's dividend yield is currently sitting way above its 5-year average by a margin of over 53%. This pushes the yield to around 1.6%. Again, not the highest yield, but the other dividend factors look pretty good. The payout ratio remains on the lower end, coming in just under 40%, which is a good sign. The 5-year growth rate sits comfortably in double digits at over 11%. Additionally, Nike boasts an impressive 11-year streak of dividend increases. With that said, I wouldn't be surprised to see Nike's share price continue to decline in the short term, especially if the economic situation worsens and consumer spending on Nike products decreases. So, if you're considering investing in Nike, I recommend caution and a slow and steady approach, perhaps through dollar-cost averaging. This means gradually buying shares over time instead of investing a lump sum all at once. This way, you can average out the cost per share over time, which can be a good strategy in a volatile market. If you've been wanting to own Nike for a while, now might be a decent time to start slowly building out that position. The third company we're talking about today is one of my favorites. Yes, you guessed it. Starbucks. I know I might sound like a broken record on this one, but right now, Starbucks is teasing us with a share price that's almost dipping below $90. It's incredibly tempting. Over the last month, Starbucks has dipped 4.4%, which isn't a huge drop, but it's a drop nonetheless. Year to date, they're down about 5%. Looking even further back, over the past year, they've declined by more than 8%. Starbucks is currently hovering near its 52-week low, which means the share price is close to its lowest point in the past year. I have about 50.5 shares of Starbucks at an average cost of $9.88. With the current share price where it's at, I'm down just a little bit. Just in terms of share price, I'm down about 0.25%, nothing too crazy. Over these last few months, I've been really focusing on building out my Visa position, but Starbucks is definitely tempting me right now, and if it continues to head south, I might have to hit the pause button on Visa and go a bit more heavy into Starbucks. I'd love to continue building out this position and keep working on getting this position to over 100 shares at some point. We'll get there. But enough about me, guys. Looking at the dividend stats here, starting with the forward yield, this is coming in pretty high. It's going to be the highest yield of the day so far at 2.5%. This is about 25% above the company's 5-year average, so just like with the other two companies, we're getting a decently higher cash flow return than on average over the last 5 years. However, it's important to note that this also translates to the highest payout ratio and the lowest 5-year growth rate we've seen so far today. The payout ratio is still not bad, though, just below 60%, which means they're not paying out an excessive amount of their earnings as dividends. The 5-year growth rate is also pretty decent too, coming in just below 10%. And let's not forget, Starbucks has been growing their dividend for the last 13 years, which is a very impressive track record. So, all things considered, I think Starbucks is a great company to consider adding to your portfolio, especially if you're an income investor looking for a reliable dividend payer. And of course, Starbucks is a well-known brand with a loyal customer base, so that's another plus. Now, along with these three companies, there are still quite a handful of other stocks out there that I think you need to keep your eye on. The first of which is actually going to be Apple. In the last month, Apple has seen a near 6% decline, and year-to-date, they're down a whopping 11%. So, might be a good one to keep an eye on, especially for those who believe in the long-term potential of Apple. Next up, but before this, you can consider subscribe me for more valuable videos. Moving ahead, we have Agree Realty Corporation, who's down 22% in the last month, and looking at their year-to-date performance, they're down about 11%. A pretty big drop, but if we zoom out once again over the last year, just in the last 365 days, they're down 16.5%. So, we're seeing red across the board, but it's important to consider the long-term outlook for the company as well. That's it for today, guys. I hope this information helps you with your investment decisions. Remember, this is not financial advice, so always do your own research before investing in any company. And as always, let me know your thoughts in the comments below. Until next time, happy investing.